This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Stocks are hot, but the economy is not. What's driving the market, holding back the economy, and what does it mean for your investments?
Health law hurdle, plans canceled, sticker shock, anger, frustration, and today a White House official on Capitol Hill was asked to explain why millions may not be able to keep their insurance plans.
And 1 year later, on the anniversary of Hurricane Sandy, new legislation is being introduced that could delay big hikes to flood insurance premiums, helping homeowners keep their heads above water. All that and more tonight on Nightly Business Report for Tuesday, October 29th.
Good evening, everybody, and welcome. On this day in 1929, the stock market crashed. The Dow lost 30 points, when 30 points meant 12%. They called it Black Tuesday. Today, 84 years later, the Dow closed at a record high. So did the S&P 500, the Dow Transports, the Russell 2000, and the Mid-Cap 400. Call it Green Tuesday if you'd like, but some of the economic indicators market pros watch, including several out today, are flashing yellow, maybe even red. More on that in a moment. But here for the record are the numbers on Wall Street today, a day of historical irony as the Federal Reserve's policymakers convene to discuss the economy and what to do about it. The Dow, with a last-hour sprint, ended up 111 points. The Nasdaq gained 12 and is now within 50 points of 4,000. And the S&P added nearly 10.
Well, investors enthusiastically bought up stocks, undeterred by a batch of disappointing economic reports. Retail sales fell in September, down 0.1%, but that was the first drop in 6 months. The decline was mostly because of a big drop in auto sales. Home prices also cooling off. The S&P Case-Shiller Index that tracks 20 cities showed home prices rose only 1.3% in August, its smallest monthly gain since March. And consumer confidence down. The Conference Board's index slipped to its lowest level in 6 months. So the data points down, but stocks continue to go up. In normal times, this probably wouldn't happen, but these are not normal times.
On Wall Street, stocks keep going up. It's been a slow grind upward, a steady drumbeat of new highs. If it's not the S&P 500, it might be the Russell 2000 or the Dow Transports, and hundreds of companies watching their stock prices hit new 52-week highs. What's going on? It's not because of earnings.
The market sometimes follows profits and sometimes it doesn't.
And it's not because of consumer spending. Auto sales fell more than 2% last month, and the pace of home sales is also slowing. In fact, consumers are feeling pretty lousy these days. A new survey shows a sharp drop in consumer confidence, partly because of the government shutdown, partly because hiring is still weak, and partly because people are just plain worried. So why the disconnect between what's going on here and here? It's because of this man. Federal Reserve Chief Ben Bernanke has been deliberately keeping interest rates super low, making more money available to consumers and businesses. The result? Cash is pouring into the stock market.
This party is artificial. This party is, I hate to call it a Harry Potter market, okay? This is a dream world market.
So far, there's nothing that'll rattle people out of that dream. Policymakers meeting today and tomorrow in Washington are expected to keep stimulating the economy. And Wall Street pros say that as long as the economy muddles along, they don't see policy changes coming anytime soon.
We've had just modest economic news. Why is that going to change? I think, we continue to have growth that's okay, but not great.
And until the economy is healthy enough to take the Fed out of the equation, it looks like stocks have an all clear to run even higher.
And many market pros and economists are now saying the Fed won't begin trimming back on that stimulus program until April or even later.
Joining us now to talk more about the weak economy and the strong stock market is William Delwich. He is a market strategist with Robert W. Baird. William, welcome. Good to have you with us. A Harry Potter market, a dream world market. You heard what David Darst just said. Do you agree with that?
Well, I think to some extent, yeah, that's certainly a disconnect between what we see in the economy and what we see in the stock market. The stock market's hitting all-time highs while the economy is still stuck in first gear, 3 years after recession ended.
So what is it going to take for the economy and the stock market to track each other better, in like more normal, in the way it is in normal times?
Well, I think first we should step back and realize that the market and the economy can move away from each other for an extended period of time. But given that, to get them back kind of on the same page, I think we need policymakers to get out of the way and uncertainty in D.C. start to fade, and then those underlying positives in the economy can start to kind of bubble to the top, and we can start to get going again.
So you seem to be saying that the disconnect between the economic fundamentals, between, say, corporate fundamentals, earnings, and stock prices can be persistent for long periods of time. Do you think we're obviously in that kind of situation right now? What could derail it and send everything going the other way?
Well, I think an aggressive backing away from easing by the Fed would be one thing to look at, but I don't think that's likely to happen. They know kind of the boat they're in, and they know what's going on, so I don't think they're going to step back aggressively right now. And until then, you'd have to see some weakness internally in the stock market, or really excessive optimism on the part of investors, and that isn't present just yet.
And the economy is pretty weak, about 1% growth, maybe 2% growth. What do you see as the speed limit for the economy looking ahead?
Well, I think in the immediate term, I think 1.5% to 2% growth is about what we can expect. But if you step back and think about it, 2% growth and really low inflation, that's not really an altogether bad situation for stocks historically. So as long as we continue to have low inflation and some growth, I think the stock market can continue to muddle higher.
No, and you've also got very low interest rates, which reduces the cost of capital for and makes borrowing more more accessible to more companies. What sectors of the stock, if you had some discretionary money to put to work right now, even at these prices, where would you put it sector-wise?
The three sectors we're looking at right now are consumer discretionary, industrials, and materials. Those are the strongest sectors in the market right now. They've been strong for a while.
But why consumer discretionary if the consumer's low on confidence and they're not really spending all that much?
I know that's the ironic thing is that you can construct an argument about why that would be a bad sector to be in, but the reality is that that's a sector that continues to move higher, and at the end of the day, it doesn't matter what you think might happen. What matters is what is happening, and what is happening is the consumer discretionary stocks are rallying and they continue to move higher.
William, thank you very much for your help tonight.
Sure.
William Delwich of Robert W. Baird.
Some stocks trading at sky-high prices actually have what's known as price-to-earnings ratios that would cause most investors to pull their money out. But that's not happening in this market. Dominic Chu takes a look to see if some of those stocks and the companies are really worth it.
Stock price isn't the only way to value a company. Many investors use other measures as well, like price-to-earnings ratio. Simply put, it's how much you pay for each share of stock relative to the profits that each share entitles you to. So, if a company has $100 in profits and has 100 shares outstanding, each share is entitled to $1 of corporate profits. Some companies trade at very high valuations. Take 3D Systems. The maker of three-dimensional printers has surged 66% so far this year and trades at 132 times earnings, meaning you'll pay $132 in stock price for every $1 of corporate profits. Then there's Facebook. The stock is up 86% this year and trades at 206 times earnings, or $206 in price for every $1 of corporate profits. Another stock that has a lofty valuation is Wendy's. The quick service restaurant company is up 83% this year and trades at 208 times earnings, meaning, again, you'll pay $208 for every $1 of profits. For comparison's sake, the Dow Jones Industrial Average trades at 14 times earnings. Some investors are only willing to pay up if they think the company will be able to meet the lofty expectations that come with these lofty valuations.
If you have a small speculative part of your portfolio where you want to take a chance, you've got to do it where you're confident the management knows what they're doing. And I don't mean in terms of operating the company, I mean in terms of keeping guidance at a level where they can beat it.
Earnings multiples are just one piece of the puzzle, but worth considering if you're looking to buy that fresh, hot stock. For Nightly Business Report, I'm Dominic Chu.
There is no downplaying IBM's importance to the Dow Jones Industrial Average because it's so high priced, second only to Visa among the Dow 30. When it moves, it drags the index along with it, far more than lower priced stocks. And today was Big Blue's best day since January. It added $15 billion to its stock buyback plan and said it will go for even more next October. That juiced the stock. IBM, up more than 2.5%, was the biggest gainer in the Dow today, responsible for 30 of the index's 111-point gain.
Morgan Stanley wants to buy back more of its stock, but it needs the Fed's okay to do that. Big banks have to get the Federal Reserve's approval before they repurchase their own stock or pay a dividend to shareholders. The Wall Street Journal says Morgan Stanley is looking to widen the $500 million buyback plan that was approved earlier this year, but it's scheduled to wrap up next year.
Major snag in the proposed $13 billion settlement between the Justice Department and J.P. Morgan Chase over bad mortgage bonds it sold ahead of the financial crisis. Dow Jones says the massive deal may be falling apart over the inclusion of possible criminal charges against the bank and over liability issues about who bears financial responsibility for bad loans tied to Washington Mutual, J.P. Morgan Chase, or the FDIC. J.P. Morgan acquired that struggling lender, Washington Mutual, during the financial crisis from the FDIC, which federally insures bank deposits.
A new turnaround plan from Sears today. It wants to spin off some of its successful businesses. Sears is considering splitting its Land's End retail and catalog business and its Sears Auto Center outlets into separately traded companies. It also plans to close more of its unprofitable Sears and Kmart department stores. Investors like the plan. Shares of Sears Holding shot up nearly 12% to $62. And still ahead on the program, millions of Americans may not get to keep their health insurance plans, even though they like them. And today on Capitol Hill, a White House official had to explain why.
Today's kickoff of the Federal Reserve's latest policy meeting on interest rates will be one of the last ones with Ben Bernanke as chairman. Current Vice Chair Janet Yellen, nominated by President Obama to be the next head of the Fed, is now expected to have her confirmation hearing in the Senate begin on November 14th. Even though Kentucky Senator Rand Paul says he'll oppose Yellen's nomination unless the full Senate votes on his bill supporting more transparency of the Fed's policy moves, Yellen is expected to win the Senate's approval.
Pfizer reported earnings that beat estimates, and that's where we begin our Market Focus segment tonight. Cost cuts and a jump in sales of new cancer drugs helped the big drug maker deliver strong results. But global sales fell because of competition for generic drugs like cholesterol fighter Lipitor. But the good outweighed the bad. Shares of Pfizer hit a 9-year high to $31.21. The stock is up almost 23% this year. A big earnings beat from LinkedIn after the market closed. Revenue and user growth climbed, and the social networking site reported progress in transitioning to mobile devices. But the company did issue a conservative revenue forecast for the fourth quarter and the full year. That pushed down the stock in after-hours trading. In the regular session, though, LinkedIn rose almost 2% to $247 and change. Goodyear Tire shares tumbled today after reporting earnings that missed analyst estimates. The biggest U.S. tire maker said revenues fell 5%, blaming lower sales of tire-related chemicals in North America and also changes in the value of Asian currencies. A modest increase in global tire sales didn't ease investor worries. Shares plummeted almost 6% to $20.76.
Weakness in the mining sector is hurting Cummins' bottom line. The maker of engines and other vehicle parts reported profits below estimates, and the company cut its full-year outlook. Cummins said it is seeing weak demand in most of its markets. The stock off more than 5% to $127.90. Shares of Nokia surged today after the company forecast a more profitable future for its network equipment business. The unit will become Nokia's main business since it sold its cell phone division over to Microsoft. Now, the telecom company reported an unexpected profit, but revenue missed expectations. The stock was up more than 10% to $7.45. And cuts in government funding hurt Aetna's private Medicare business, and that sent shares lower. The health insurance company's profits missed estimates, and Aetna kept its cautious outlook. On the bright side, revenue did come in above estimates, boosted by its recent acquisition of Coventry Healthcare. The stock still dropped more than 1.5%. It finished at $60.75.
Well, Aetna CEO Mark Bertolini was also asked about the new health law and a report today that says the Obama administration knew millions of Americans would not be able to keep their insurance plans.
The only people who can keep their plan indefinitely are people who in the individual and small group market were in that market before March 23, 2010, and over that period, from March 2010 till now, did not change their plans.
Accusations that the White House misled people to believe they could keep their insurance plans, combined with troubles on the government's health care website, resulted in some heated questions at hearings on Capitol Hill today about what went wrong and who's to blame. Bertha Coombs has more.
Mike Salamone was surprised when Anthem Blue Cross notified him this month his family health plan would no longer be offered.
The primary reason they said is that there's about 10 or 11 components that every plan has to carry.
The retired St. Louis executive says a comparable plan on healthcare.gov will cost him twice as much, $1,400 a month, because he doesn't qualify for subsidies.
I was very shocked to find out that my plan was being canceled and it was not compliant. And my shock, I guess, kind of turned maybe to anger.
There was plenty of that anger at today's Ways and Means hearing directed at Marilyn Tavenner, the chief of CMS, the Centers for Medicare and Medicaid.
This man wrote me and said, "My wife has been recently informed by her insurance carrier that her health care policy does not comply with the Affordable Care Act."
Tavenner's defense? Insurers had the option to update under the Affordable Care Act and were known to cancel plans before the law.
Half the people in the individual market prior to 2010 didn't stay on their policies. They were either kicked off for pre-existing condition. They saw their premiums go up at least 20% a year.
An NBC investigation found the White House knew between 45 to 75% of plans in the individual market did not comply with ACA benefit requirements and would have to change, countering unqualified assurances from President Obama.
If you're one of the more than 250 million Americans who already have health insurance, you will keep your health insurance. This law will only make it more secure and more affordable.
But change was to be expected, says Georgetown's Sabrina Corlett, with the individual market effectively now one large pool.
If you're an employer-based coverage, if you're a healthy person, you are subsidizing your fellow employees who might have more health care needs. It's the same idea.
For Republicans, it's another Obama health care promise not delivered, like the healthcare.gov website.
The whitehouse.gov website today says if you have health insurance that you like, you will be able to keep it. She has health insurance that she likes. She's been paying her premium. She wants to keep it, but she can't. Isn't that a lie?
Mike Salamone would like to see less partisan fighting and more flexibility for millions like him.
Allow choice and allow us to be better shoppers and get something that meets our requirements.
It's Health and Human Services Secretary Kathleen Sebelius' turn in the hot seat tomorrow. In her prepared remarks for the House Energy and Commerce Committee, she touts how, for most Americans, premiums will be lower under the Affordable Care Act. She will no doubt be grilled about that. Bertha Coombs for Nightly Business Report.
Coming up, fees for everything from checking bags to printing out boarding passes. They're helping airlines collect a record amount in ancillary revenue, but what's the real cost to you?
The proposed merger of U.S. Airways and American Airlines may be closer to liftoff. Both carriers and the U.S. Department of Justice have agreed to use a mediator to help settle the government's lawsuit to stop the proposed deal. Justice officials are concerned that the merger would limit competition and could result in higher airline ticket prices. Now, if the sides can't settle their differences with the federal mediator, a trial to stop the merger is scheduled for November 25th.
A new study says airlines around the world will collect a record $42.6 billion in ancillary revenue this year. A good chunk of that money comes from the fees passengers pay for everything from checking bags to printing out boarding passes. So how much more are these fees adding to the soaring cost of air travel? You'll be surprised. Phil LeBeau has the answers.
Let's be honest, travelers are fed up with airline fees.
These airline fees that bother me particularly would be baggage, first and foremost. It should be part of the ticket price.
Baggage fees and internet. It's just nickel and diming.
Now they're charging you extra money just to put a bag on the plane, which is, I think, a little bit over exaggerated.
Ancillary revenue for airlines worldwide keeps climbing, almost doubling in the last 3 years to $42.6 billion. Now airlines are looking for new ways to get you to spend more money.
I think the hesitancy that airlines had is quickly passing. And I think that when done fairly, I think it actually serves the consumer well.
So how much can fees add to the cost of a plane ticket? We went online to United Airlines to book a one-way ticket from Chicago to Los Angeles. A one-way ticket in coach, $422. That's the base fare. But if I need to check a bag, that's another $25. Priority check-in so I can board early and get overhead bin space, $9. If I want extra legroom, on this flight, the last seat in the middle costs me $72. Wi-Fi in flight so I can surf the web, $14. Lunch, which is a turkey and Swiss baguette, is another $8.99. Altogether, these extras will cost me just under $137 and drive up the cost of my trip by 32%. Keep in mind, different flights on different airlines could mean much higher or lower fees. United, as well as other airlines, point out they're not forcing you to pay for lunch, board early, or other extras when you fly. And carriers say the average airfare in the U.S. since 1980, adjusted for inflation, is down about $200.
It is generally about as cheap as it's ever been to fly. I mean, you look back at the last 70 years, in the 1950s, the 1960s, no one was flying. 80% of the country was not flying in airplanes, and that's because the government regulated the airlines, and it was unaffordable to fly.
You may not like it, but airline fees are here to stay and will likely go up in the future. Phil LeBeau, Nightly Business Report, Chicago.
For more on the extra fees airlines are charging and how much consumers like you and me are paying, head to our website, nbr.com.
And finally tonight, 1 year after Superstorm Sandy hit the eastern shore of the United States, causing an estimated $62 billion in damages, lawmakers are moving to push back big increases in flood insurance premiums that could threaten the finances of hundreds of thousands of American homeowners. Mary Thompson reports.
In the last year, floods ravaged homes from Boulder, Colorado to Minnesota's Twin Cities to the Jersey Shore. The disaster is forging rare bipartisan support for a bill to delay rate hikes on flood insurance premiums that threaten these homes again. Here's New Jersey Senator Bob Menendez.
We still have too many people out of their homes and too many people who are afraid of losing their homes. We've suffered from a natural disaster. We need not create a man-made one.
The man-made one, the Biggert Waters Act, well-intentioned legislation aimed at restoring the financial health of the National Flood Insurance Program, which is $26 billion in debt. The Act's aim, refund the program by charging market rate premiums for hundreds of thousands of homes in flood zones. The problem, a lot of those previously subsidized homeowners can't afford the new rates.
Nobody's arguing against reasonable rate increases. What we're arguing against is rate increases that could go to $20,000, $25,000 a year and literally push people out of their homes and out of the program.
To counter it, Louisiana Senator David Vitter and others introducing the Homeowners Flood Insurance Affordability Act. The act delaying by 4 years rate hikes on insurance that covers homes in flood zones that were built in accordance with previous building codes and homes that were sold or policies bought after July 6, 2012. That's when Biggert Waters was passed. Primary homes in repetitive flood zones, secondary homes and businesses would still pay higher rates. The proposed delay giving FEMA time to complete new flood maps, along with an affordability study on the rate hikes and the rules on how to implement them. Given the bipartisan support, there is optimism this bill will pass, probably when it's folded into a budget bill that will be approved later this year or in 2014, keeping many homeowners from going under financially. For Nightly Business Report, I'm Mary Thompson.
Well, the anniversary of Sandy brings this really right home to so many of us in this area where we were all hit.
Beautiful sunny day today. You wouldn't think that there were, strong winds and couldn't get to work and roads were closed and people
really
homeless.
Something. All righty.
Well, that's it for us. Nightly Business Report for tonight. I'm Susie Garib. Thanks so much for watching.
And I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody. We'll see you right back here, we hope, tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garib with a Nightly Business Report news brief. On this day in 1929, the stock market crashed, but today the Dow and the S&P 500 both closed at record highs as the Federal Reserve meets on the economy and interest rates. The Dow jumped 111 points, the Nasdaq gained 12 and is now within 50 points of 4,000, and the S&P added 10 points. Stocks rallied even though new data shows consumer confidence at a 6-month low, a decline in retail sales because of a drop in auto sales, and a slowdown in home price increases. The $13 billion settlement between the government and J.P. Morgan Chase may be falling apart over possible criminal charges and over who will pay for the bad mortgages it sold. And Sears may spin off its Land's End business and its Sears Auto Center outlets into separate companies. Be sure to tune into Nightly Business Report right here on your public television station.